Good morning. Today we have stock markets in the US at a record high. We're going to dig into the details of why that is. Yesterday we saw equities continue their impressive year-to-date run. We saw the US stock market, the S&P 500, close at a record high. The economic environment for equity markets remains encouraging. We've seen central banks around the world lower interest rates, the Federal Reserve cutting interest rates by 0.5%, more than double that of what we saw from the Bank of England in August. And that's really because the balance of risks have really changed from battling inflation to now becoming a little bit more concerned about how the strength of labour market is trending. I suppose when the US interest rate cut came through 3 weeks ago, there was some concerns that employment was weakening at a faster pace. We had the employment report in the US last Friday, which actually pushed against that, and I was actually much stronger than expected. So the labour markets are performing well, and that's helping the US economy. When we look at more timely measures of GDP, looking at the Atlanta Fed and Nowcast series, it's suggesting that the US economy is growing at 3.2% for the third quarter, which would suggest that real GDP is also reaching a record high. Now, equity markets yesterday reached new highs, and that was despite the minutes from the last central bank meeting in the US being released, which suggests that the voting members that in aggregate agreed to cut interest rates by 0.5%, there were some members wanting a more gradual pace of interest rate cuts in the future. Despite that, equity markets took it in its stride and continued to push on, whereas the bond markets saw a little bit of weakness as they begin or continue to price out the number of interest rate cuts expected over the next 12 months, which is a development that we've seen over the last week after that stronger than expected employment report. Now, today, inflation will be back in focus for investors. We'll get US headline and core inflation. Core inflation is where we strip out volatile components such as energy and food. Expectations is that inflation will continue to grind lower, which is very much the trend that we've seen. Headline inflation expected to come in below 2.5%, and core inflation, which has been a little bit more sticky, expected to be just a little bit above 3%. Bond markets will be focusing on that, as will equity markets, and we'll keep you up to date with that with our next video tomorrow. That's everything from us. Thank you for watching.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.